All right, good afternoon, everybody. Welcome to today's OptionsPlay webinar. Today's topic is technical analysis and directional trading. My name is Scott Green, Marketing Director with Regal Securities, and soon I'll be introducing our main speaker, Tony Zhang of OptionsPlay. This is our 8th webinar on our OptionsPlay series. For those who are new, OptionsPlay is a tool on your trading platform that was recently launched to help you with your analysis, strategy, and research for trading options. And it's highly integrated with your trading platform. If you're having trouble finding it, you don't see it, I'll show a screen of where you can find it, but you can always contact your broker customer support and they'll be able to help you out. Today specifically, we'll be going over, Tony will be talking on leveraging technical analysis, add timing to options trades to deliver results, and automating your analysis and options strategy using OptionsPlay. Once he dives into this, we'll go over that for about 30 or 40 minutes. Then we'll have about 15 minutes of Q&A afterwards. So next, I just want to take a moment to share this disclaimer. The types of securities, forms, and research tools used in this webinar are for demonstration purposes only and should not be considered a recommendation by Regal Securities or a solicitation or an offer to buy or sell any options. This webinar will be recorded and is being recorded and is not intended to be used for individual tax, legal, or investment planning advice. So now I want to introduce our speaker, Tony Zhang, the guru and chief strategist at OptionsPlay. Tony has over 12 years experience in the financial services industry. He oversees the OptionsPlay developers, and that team has led to the development of some of the most innovative tools in options trading and analysis. OptionsPlay is currently embedded in several major sell-side brokerage firms as well as a direct-to-consumer platform. And Tony has helped build up the products as well as bringing it to market. And he has developed and maintained many of the firm's partnerships. And so before I hand it off to Tony, just want to highlight where you can find OptionsPlay on your platform. There's tabs and you can find it right there. If you're having any trouble finding it, please contact your brokerage customer support and they'll be able to help you out. So with that being said, I'll hand it off to Tony.
Thank you, Scott. Thank you everyone for joining me. I'm just going to share my screen here. Okay, welcome everyone. Welcome back to our educational webinar series. Today we're going to be talking about leveraging technical analysis with your options trading. The reason we want to talk about this topic is because to trade options successfully, it requires everyone to have at least some directional view on any stock that you're trading an option on. Even if you're generating income, it does help to have a directional view on the underlying stock in order to successfully trade options. So technical analysis is a really popular tool to allow you to quickly gauge, whether you feel that the stock is moving in a specific direction or not over a specific time period. And that is critical for options trading because you have an expiration date on your options. So it's really important to have a directional view within a specific time period that you may not always get if you're using fundamental analysis or other forms of analysis. That's why options trading, that's why technical analysis is very, very popular amongst options traders. So today, what I want to do is spend a bit of time going over introducing technical analysis for those of you that are brand new, talking about the different forms of technical analysis that you can apply to trading, and more importantly, what are the appropriate strategies for each type of analysis. Because there are so many different ways to analyze a chart or use technical analysis with your trading, we really want to make sure that you are utilizing the right strategies for specific types of technical analysis, because I tend to find people kind of applying technical indicators in a different way than they were intended to, specifically with regards to options trading. So that's why I want to cover the different strategies and how to leverage them using OptionsPlay. Now, before I get started, how many of you currently use technical analysis or charting in your trading? If you use technical analysis or charting, please type yes into the chat window. just so I get a feel for who is in the room. And if you don't use technical analysis, if you use other forms of analysis, just please type no. So far, it looks like pretty much every single one of you has said yes to using technical analysis with your trading, which is great. That means that, you know, this is going to be a great topic for those of you to go to just review the different forms of technical analysis and more importantly, understand what is the best strategy to use. So I'll do a quick intro to technical analysis. Seems like most of you are familiar. I want to talk about the option strategies that are suitable for different forms of technical analysis. Then we'll dive into the different forms of technical analysis. So for example, you have chart analysis and patterns. We have chart overlays, chart indicators, and different types of market analysis. I'll go over each one, what they mean, what the different forms of how you should utilize them using options. And then lastly, what we'll do is we'll actually show you how to use them on OptionsPlay. So we'll pull up some real examples of some stocks with some technical setups and go through the different strategies that you can utilize with OptionsPlay to quickly help you decide which option strategy is best suited for your form of analysis. So just a quick intro, what is technical analysis? It's the simply forecasting future prices based on past chart movements. And technical analysis is really trying to anticipate what is likely going to happen in the future. This is the belief that that history may not repeat itself, but it certainly rhymes, is the fundamental belief of every technical analyst, that you can discern patterns that happened in the past and apply them to what is likely going to happen in the future. But one of the best things about technical analysis is the fact that it's applicable to all tradable instruments. Any instrument that you can chart, you can apply technical analysis to. And that's really why this is one of my favorite uses of, this is one of my favorite forms of analysis, is because I can use my skill set in technical analysis and not only apply it to stocks, but also to other markets like fixed income and commodities and interest rates and all the other things that actually affect stock prices. I can get a feel for what's going on in those markets and use that information to help inform my decisions when I'm trading stocks. So that's really why I like to use this, because it allows me to look at all different types of things and gauge what's happening in those markets. Now, technical analysts, what we believe in is that what is more important than why. The reason for this is because if you've ever noticed that when news announcements come out, when certain things that impact the stock, you know, we tend to see the prices change almost instantaneously right after that news announcement or event comes out. And the reason for this is because markets are efficient, and then it prices pretty much everything instantaneously into, or prices all information instantaneously into the market. So we don't really care about why something happened. We care about what happened based on that event, because that helps us determine what is going to happen in the future. And the fact that markets are not random is also a thing that we need to understand when we're using technical analysis. Again, the belief that there are patterns in the market that repeat over and over again, and that it's not completely random, or else technical analysis would not be useful. So with all of this information, let's actually take a look at how would you use different forms of technical analysis with your trading. So first, before I talk specific about specific forms of technical analysis, I want to first review the few different types of strategies that you would generally utilize, or the more popular strategies you would utilize if you have a directional view on an underlying stock from technical analysis. Now, one of the reasons that I like to use options with my technical analysis is simply because of the fact that it limits my risk when I use options. No matter what type of option strategy you trade, if you trade any of the three strategies that we're going to show you here today, each one of them have limited risk. So meaning no matter how bad your charting is or how wrong your charting is, you are still limited in the amount of money that you can lose. And that's critical to just basic money management for traders. Doesn't matter whether you're an options trader or a stock trader or a futures trader or a Forex trader, you have to have good money management skills. And options allow us to almost force us to do that by limiting our risk. Unlike buying or shorting a stock or a future or Forex, you have potentially a substantial amount of risk. When you buy an option or sell an option or credit spreads, you have limited risk. So no matter what happens, you can only lose a certain amount of money. And that's really critical to the success or long-term success of a trader. So what I've broken down in terms of option strategies into two categories. One where you have a clear entry price, but you have an unclear exit price. And I'll talk a little bit about what that means, and that will make a little bit more sense as we go through the different forms of technical analysis, because there are certain forms of technical analysis where you get a clear entry price, but it's not really clear as to what the target price is or where you're going to exit this trade at. So for those types of trades, it's best to use strategies like buying calls and puts, so long calls or puts. This is usually when you expect a quick or fast move in one direction, but you don't really have a target price for it, or selling credit spreads when you expect a neutral or a small directional move. So again, both of these strategies are useful for if you have a clear entry but not a very clear target. If you expect a quick and fast move in one direction or another, it's best to buy calls and puts. If you expect a small or maybe even a neutral movement in the underlying stock, then it makes sense to sell credit spreads. So we'll go over in a little bit the different forms of technical analysis that these types of strategies are useful for. The second form of technical analysis is where you have a clear entry price and a clear exit price. So a lot of times there's many methods of technical analysis where you have a very clear entry price and you have a very specific target price. So for those types of strategies, it's usually best to utilize debit spreads. This is where you expect a modest directional move in one direction or another. But with that clear target price, debit spreads really allow you to fully capture the directional move that you're expecting in one direction or another using options while minimizing your risk and minimizing your time decay, which is really what works against you when you're just long calls or puts. And calls and puts are useful when you expect a quick and fast move. Debit spreads are more useful when you expect a modest directional move and you have a clear target price in a specific direction. So with those three different strategies in mind, let's start taking a look at different forms of technical analysis and how you can utilize them in your trading. So first, I'm going to talk about chart analysis. This is where we're talking about just purely looking at the charts. And when we're looking at the charts, one of the easier things that we can identify is things like support and resistance levels and trend lines when you're first starting out with analyzing a chart. Support and resistance lines, how many people are familiar with the concept of support and resistance? If you are, type yes. If you're not, type no, just so I get a feel for who's in the room here. Okay, so pretty much everyone here is familiar with the concept of support and resistance, right? So as you can see on my chart, I have 3 levels of support here around 33. I have 3 levels of resistance around 42. Very clear, when it hits that support level, you're expecting a bounce higher. When it hits that resistance level, you expect a bounce lower, and vice versa. So with support and resistance levels and trend lines, and this is by no means an exhaustive list of chart analysis. There's many, many different ways of how to do this. You can get into much more esoteric things like Fibonacci lines and things like that. So this is just going to cover the basics, because all of those other forms of chart analysis is just a derivation of different ways to figure out where support and resistance is. I prefer really, really simple methods like horizontal lines, because those are the ones that most people will tend to look at, and whatever people most look at is what's likely the markets are going to react to. So based on simple support and resistance lines, and I'm talking about horizontal support and resistance lines, these types of strategies provide you with a clear entry and clear exit. Because if a stock hits that support level and it bounces off, I have a pretty fair amount of confidence that it's going to rally up to that next resistance level. Same thing if it hits that resistance level. I have a fairly high amount of confidence that it's going to bounce off that resistance and trade all the way down to that next support level, and vice versa. This means that I have a clear entry as to when to get into that trade, when it hits that support or when it hits that resistance, and I have a clear target price, which is that next support or next resistance line. So which is why these types of strategies are really useful for when you're trading debit spreads. However, the support and resistance can also be used different ways. So meaning if you hit a support level, you may not think that it's going to go all the way up to that next resistance level, but you can simply say that just because it hit support, I'm pretty confident it's not going to go any lower. So that's why I have also credit spreads here, because you can feel that the stock has hit a support, but you may not think that it's going to rally to that next resistance level. But you might just think that, hey, the stock's at 33, it's hit that support level, I don't think it's going to go any lower. If that's the case, that's when you might want to sell a credit spread instead of buying a debit spread. Debit spreads for if you really expect the move to happen and you expect it to move to that next resistance level. If you simply feel that the stock's not going to go any lower or not going to go any higher because it's hit a support resistance level, that's when you can sell a credit spread. Okay, so that's just a very quick, very simple understanding of how to use support and resistance lines. You may find your support and resistance lines by other forms. There's plenty of other ways to derive support or resistance. Again, I prefer the simpler methods like drawing horizontal support and resistance lines. But however you derive your support and resistance lines, you can use these two strategies to help you determine which strategy is best for you. Debit spreads if you expect a move to that next resistance level, or a credit spread if you simply think that it's hit a bottom and it's not going to go any lower. Next, I want to take a look at is breakouts and breakdowns. So this is also a fairly familiar strategy, I think, for most people that have used charts before. You can identify a stock's trading within a specific range for a period of time, and then all of a sudden either breaks down or breaks higher. Now, this type of strategy is usually classified with what we consider a very clear entry, because we know exactly where the range is. We know when it breaks out of that range. However, as far as how far it's going to go, we have a fairly unclear exit. There's no clear target price on these specific types of strategies. So that's why for these types of strategies, it's usually best to simply buy calls and puts, because number one, these moves tend to happen very quickly. They are not something that happens slowly. As you can see, these breakdowns tend to happen very, very quickly over a very short period of time. And the strategy that is really able to capture that is really just outright buying calls and puts. And the one thing to kind of remember is that breakdowns typically happen faster than breakouts. And this is simply because we tend to have negative news that cause big moves to the downside. Think what happened in Netflix, versus really positive news will certainly have cause a stock to break out or break higher, but usually you don't get the same type of violent moves that you see to the upside as you do to the downside. So that's why, generally speaking, puts will always trade at a slightly higher premium than calls, because of this skew that we have, if you will. So for any of you that are familiar with the concept of skew, puts will always trade at a higher premium than calls for the same amount of protection, but because puts tend to have a higher probability and they tend to move a little faster, that's why they tend to be a little bit more expensive. So keep that in mind when you're buying calls and puts for when you're expecting either a breakout or a breakdown, okay? So another form of analysis that we want to see, and I actually have an example of this, is common breakaways, common or breakaway gaps. So this is, again, a type of breakaway type strategy where you have a clear entry because you see exactly when the stock is kind of trading in a range and it starts to break above that. However, with these types of analysis, you generally have an unclear target price. You don't really know where it's going to go. You don't know how far it's going to go. You may not even know how long it's going to take, but they tend to be relatively quickly. So they tend to move relatively quickly. So that's why buying, again, calls and puts in this particular strategy is generally best. So keep this in mind when you're looking at different forms of charts, especially if you have a vast knowledge of technical analysis, you're likely to incorporate some forms of these things that I'm talking about in all of your analysis, and every single chart looks different. So on some charts, you might identify support and resistance. On other charts, you might identify breakouts. On other charts, you might use oscillators. It's just important to come back to these slides and look at this webinar, because you want to refresh yourself in terms of understanding which types of strategies are useful for different forms of technical analysis. Next, I want to take a look at chart patterns. How many of you have looked at things like double tops or triple bottoms or triangles or rectangles in your technical analysis? If you have, type yes, because I know I certainly have, and they're very, very useful for options trading. So especially when we're talking about head and shoulders, these are very, very popular, strategies that or patterns that many people look out for when they're trading. And you may not necessarily look for them. You might just be pulling up a chart and all of a sudden recognize a double top or a head and shoulders. How do you actually trade them? So these types of reversal patterns like double tops and head and shoulders that tell you that a trend is kind of coming to an end and starting to reverse, these tend to have very clear entry prices because you know exactly when they're formed and when they're completed. However, you don't know when what the target necessarily is. So this is again where calls and puts sometimes can be useful depending on if you expect the move to happen relatively quickly. This tends to happen with double tops and head and shoulders, or sometimes you can sell credit spreads. So on a double top, this is telling me that basically the stock is kind of hit an all-time high or hit a 52-week high or hit its relative high, and it's bounced lower and it's going to start moving lower. So there's two ways to play this. You can either feel that the double top is the sign of a top and it's going to start reversing lower. If that's the case, you might want to just buy a put option. If you found a double bottom, you might want to buy a call option. The other way to think about this is that these reversal patterns simply tell you that the stock is no longer to go any higher or is not going to go any lower. So here in this example of Gillette, this is telling you that the stock is no longer going to go any higher. So what you can do is you can sell a credit spread. You may not necessarily have a lot of conviction that the stock's going to go much lower, but you certainly have a fair amount of conviction that the stock's not going to go any higher. In those particular cases, you might want to sell a credit spread instead of just buying an outright call or a put. If you're more convicted that the stock's really going to reverse lower, then that's when you might want to buy that put option. So, this is by no means, again, an exhaustive list of reversal patterns. There's many, many more, but they all tell you relatively the same thing, that the stock is kind of is starting to reverse direction. And these are the ways that you can play this depending on the different forms of chart patterns that you look out for. The next form of chart patterns that very, very popular is continuation patterns. This is looking for flags, pennants, triangles, these types of things that tell you not that the stock is reversing, but the stock is just consolidating for a while and it's going to continue in the direction that it entered that formation in. So flags and pennants are very, very popular. And the great thing about these types of strategies is that they give you a very clear entry and they give you a very clear exit or target price. Because many times what we'll do is we'll measure the move that it took to enter that consolidation pattern or flag, and we use that move to extrapolate out to the future. So as you can see, this stock moved roughly $10 from the beginning to enter that flagpole, and once it became a flag and it broke out to the upside, we expect a move of about $10 higher in that same direction. Now, because of these continuation patterns tend to give you very clear entries and exit prices, that's when debit spreads usually are very useful in this particular trade. And the other thing about technical analysis is that when you're looking at a chart, you really get a feel for time frame. Because if you're looking at simply the balance sheets and income statements and fundamentals of a company, it doesn't really give you a sense of time, meaning how long is it going to take to become fully valued if you feel that a company is undervalued, or how long it'll be fully valued if it's overvalued. Technical analysis give you a very clear direction, a very clear indication of roughly how much time it takes to move $10. So as you can see here, it took roughly about a month and a half to go from this $28 to about $36. And then same thing, roughly about a month and a half to move from this $36 to about $46. So that's really one of the great things about technical analysis, because if you're trying to build a debit spread, now you have a pretty good idea as far as what strikes you should buy at, what strikes you should sell at, and it also gives you roughly a time frame. So if I was buying this call option or this debit spread, I'd probably look at somewhere between 1.5 months to 2 months out from expiration, because that is roughly the amount of time it took to enter this flag. So I would expect roughly the same amount of time for it to continue to that next target price. And that's really one of the great things about technical analysis. And then if the stock doesn't rally higher and it simply just moves sideways, then I know that this wasn't really a flag and that wasn't a valid trade, and I would just simply get out of that trade at that time. So not only does it tell me when I'm wrong, it also very clearly tells me when I've been wrong. I'm sorry, not only does it tell me when I'm right on the trade, but also when I'm wrong, because that's also equally important, is to get out of a trade if the technical analysis simply doesn't play out the way you expect it to. So if you're looking at a double top and the stock, instead of hitting that double top, just continues to rally higher, then that's an indication that double top didn't form, that it was wrong, and it's not a reversal pattern, and that is an indication to get out of the put or the credit spread that you sold. So that's one of the great things about technical analysis. Not only does it give you a clear indication when you're right, but also when you're wrong, and that is very key to success in trading, is cutting your losses when you're wrong. So next, what I want to talk about is chart overlays. Many of you use moving averages, Bollinger Bands. If you use moving averages, type moving averages into the chat window, because I know many of you do. And as great as moving averages are for trading, and I know many of you will use different forms of moving averages. Some people like to use moving average crossovers. Some people like to simply just, when the stock goes above a moving average, you buy. If it goes below a moving average, you sell. Very popular strategy. However, one of the things that I think a lot of people may not recognize with this is that moving averages and Bollinger Bands give you a clear entry price, but they leave you completely lost as to where the target price is. When the stock goes above its moving average, it could go above that moving average for 2 days, or it can go above that moving average for 2 years. And there's no indication based on the moving average as to how long that will take. So that is really why it's really important that when you're using moving averages or Bollinger Bands as your signal, that you simply use calls or puts because you expect potentially a large move to happen in one direction or another, or selling credit spreads. So those are the two patterns that make sense when you're using these types of strategies. So if you're using moving averages or Bollinger Bands as a breakout, you generally will want to use buying a call or a put to expect a big move in one direction or another, or you might want to sell a credit spread, because that allows you to, for example, if a stock goes above its moving average, that's a bullish indication, but it doesn't tell you how bullish. It doesn't tell you whether it's going to be bullish for 1 day or 1 year or 1 decade. So that's really why it's important to sell credit spreads, because credit spreads just basically allow you to say, I don't think it's going to move any lower. When a stock moves above its moving average and the moving average is trending higher, these are certainly indications that the stock's going to go higher, but it doesn't tell you how much higher or how quickly it'll happen. So that's why selling credit spreads many times is a better strategy to use if you're using strategies like moving average crossovers or MACD or forms like or strategies like that. So make sure that you keep these things in mind when you're using your different forms of technical analysis. And again, I'm not going to be able to cover even a fraction or the tip of the iceberg of technical analysis in this particular webinar, but I want to make sure that you guys are in the mindset of, when you're looking at your technical analysis, thinking about, do you have a clear entry and do you have a clear exit? If you have a clear entry and clear exit, there are certain strategies that are useful for that. But if you have a clear entry and an unclear exit, then you should consider using different forms of option strategies. So make sure you think of that when you're using technical analysis. Lastly, I want to talk about oscillators. If you use MACD, RSI, stochastics, or any of these oscillators, just type the oscillator that you're most familiar with using in the chat window. But I'm guessing most of you will use stochastics, MACD, RSI, William percent R, these types of strategies to give you oscillators. Now, if I go back to when I started technical analysis and I started learning about these indicators, they seemed like magic. They were able to tell me exactly when a stock was overbought, when a stock was oversold. But the one thing that I didn't realize at the time was that these may give you clear entry signals because they tell you exactly what level that they're oversold at and when you get the buy signal, when you get the sell signal. However, they are very unclear as to how far the stock's going to move. So you'll get a buy signal or you'll get a sell signal from one of these indicators, but they have no indication as to how far the stock's going to move in one direction or another. And that's really why credit spreads is the definitive strategy that you should use if you use these types of strategies. And so I have a few examples here. So here is McDonald's. As you can see, this is the RSI, a 14-period RSI, very standard indicator. As you can see, it generated a sell signal here right around when it was trading at 50. Just because it generated a sell signal does not necessarily mean that it's going to move substantially lower. That sell signal simply tells you that it's overbought. And what that really tells you is not necessarily that the stock's going to move lower. It just means that there's a relatively low probability of the stock continuing to move higher. And that's really why credit spreads is the ideal strategy for if you're using the oscillators for your trading strategy. So as you can see, again, a few days later, it generated another sell signal when it was at 52. Same thing. Just because it generated sell signal does not mean it's going to fall back down to 44 or 40 or whatever it is. It simply just means that there's not a high probability that the stock's going to continue going higher. So a month later, same thing, generated another sell signal. You could have sold another credit spread here, and when the stock trades sideways, you would have made money on that credit spread again. Same thing here. Again, it reached overbought again here in December. This time it did move lower, but again, that's the indicator itself doesn't tell you that. The sell signal only tells you that it's not going to go much higher. It doesn't really tell you that it's going to go significantly lower. So that's why, again, I feel the best strategy to use if you're using these type of overbought and oversold indicators that many of you have just talked about. I'm reading the chats that you guys sent: stochastics, MACD, Arun, time segmented volume, stochastics, RSI. These are all indicators telling you basically the same thing. They're just slightly different calculations on how to achieve overbought and oversold conditions. And it's really important to understand that overbought and oversold does not mean that the stock's going to reverse. It simply only means that the stock is unlikely to go in the same direction that it was currently in. And that's why, again, credit spreads is the ideal strategy to use when you've identified overbought or oversold indicators. So here's just another one, similar type strategy. Same thing, when you get this overbought, oversold indicator, it's not necessarily telling you to sell or buy. It just means that it's not going to continue going in another direction. And it's perfect for credit spreads. Credit spreads allow you to take advantage and profit when you feel the stock's not going to go in one direction or in one direction. So selling a put credit spread when you feel the stock is oversold, and selling a call credit spread when you feel the stock is overbought is a great way to utilize options to profit using technical analysis. So lastly, what I'll do is I'll talk a little bit about intermarket analysis. Many of you look at these forms of things, what I want to point out is things like relative strength, net 52-week highs, intermarket analysis. All of these types of market analysis that you would do on the broader market, make sure you use them as confirmation, as not signals. So a lot of people will see, oh, a stock has high relative strength, so let me buy it. That's not a great reason to buy a stock. You want to buy a stock that has, for some other reason, and then use relative strength as a way to confirm your bullish view or bearish view. If you see that a lot of stocks are hitting 52-week highs, that's not necessarily a reason to buy into the market. That's just a confirmation if you have a bullish view on the markets. Same thing with intermarket analysis. I talk about using technical analysis with your trading, allowing you to look at other markets like interest rates, commodities, just the overall market, or even individual sectors. That's one of the great things about technical analysis. But again, looking at other markets does not generally provide you with a signal. You can use them as confirmation, but not signals themselves. So make sure you think of that when you're using these types of strategies. And lastly, I highly recommend, if you're using any form of technical analysis with your trading, try to use a top-down approach. This is really just helping you align all the probabilities in your favor, meaning not just looking at what's currently going on with the individual stock that you're trading, but also taking a look at the sector that the stock is in, and also at the same time looking at what the overall market is doing. Because if everything lines up, you have a higher probability of the stock moving in a bullish view if the sector is also bullish and the market is also bullish. And vice versa, if you're looking at a bearish stock, it'll help you or increase your probability if the sector is also bearish and the market is is also bearish. So keep that in mind when you're doing this type of intermarket analysis, looking at not just what you're trading, but the thing that what's related to what you're trading. And if you're seeing similar movements in the things that's related to what you're trading, that's when you're going to increase your probabilities. So I know I covered a lot of different forms of technical analysis, and I know many of you are familiar. So I want to go through some examples here and actually show you some setups that I've noticed and how I would utilize OptionsPlay or utilize option strategies to try to profit from these specific views. So I was looking at Morgan Stanley here today, and just for just so everyone knows, this again is for illustrative purposes. This is not in any way a recommendation or solicitation to trade Morgan Stanley or any of its securities. This is simply just for illustrative purposes so that I can teach these types of concepts. So I was looking at Morgan Stanley, and this is the OptionsPlay platform on Morgan Stanley. So for those of you that are brand new, make sure that you take a look at using this platform. It's designed to make your life a lot easier. So I was looking at Morgan Stanley here because I noticed that right around $50 was a bit of a support level. It recently hit 50 back in February, bounced off 50 again here in early May, bounced off again in June, and then finally broke below that level, but came back up above that 50 level. And what it's looking like to me is the possible formation of an inverted head and shoulders here. You have a left shoulder here, an inverted head, and it looks like it's about to form a right shoulder. And it's also in a fairly strong sector. Financials have been rallying quite a bit over the last few weeks. So that's why I'm looking at a potentially bullish move here in Morgan Stanley. And if you remember from my slides, and the head and shoulders is simply a reversal pattern telling me that, as you can see, that Morgan Stanley has really kind of taken a hit over the last few months since February. And this is a reversal pattern telling me that it might head higher. So there's two ways I can play this. I either think that $50 is kind of a floor now, and I don't think it's going to go much below 50, which is where that right shoulder or left shoulder was. So that right shoulder should also basically find support around 50 and start moving a little higher. Or I can think that it's going to really rally and break above that neckline and go all the way up back to 57, 58 level. So there's a few different ways to looking at this. They're basically both clear entries, but in my opinion, not very clear targets or very clear exits. So what I'm going to do is I'm going to set up two different trades. I have the debit spread, which we talked about is an ideal trade for if you have a specific target. So if you feel that this is going to form a right shoulder and it's going to move back up to 56, which is where that next resistance level is, you might want to take a look at this debit spread. But if, let's say, you just think that it's a reversal pattern, it's not going to go much lower below 50, you're not really sure how high it's going to go. It might just go up to 52 or 53, which is where it was a few months ago. Then you might want to sell a credit spread. So that's where let's take a look at setting up a credit spread. And what I want to show you guys is how to utilize this platform so that you can put strategies side by side. Let's do a shorter dated credit spread. So let's sell a 49.50 put credit spread and compare that with the debit spread. So this is really where you can utilize our platform and using the P&L simulator to actually compare strategies, because that's one of the things that if you're looking at an option chain, so if you're bullish on Morgan Stanley, you don't really have a specific target price in mind. You're not sure if you want to trade a debit spread or a credit spread. It's really difficult to make that comparison when you're just looking at an option chain. There's simply too many options. You have to first figure out what strategy, what expiration, what strike price. Here on OptionsPlay, you don't have to do all of that. We can put up any two strategies side by side and actually just start comparing and seeing how they perform. So before I do that, what I'm actually first going to do is I'm going to say I want to risk, let's say, $2,500 on this trade so that I can compare apples to apples. So if I have $2,500 to risk, here I can sell 33 contracts with this put vertical, or I can buy 13 contracts with this call vertical. So as you can see here, both strategies give me a max risk of roughly $2,500. This one has a max reward of only $825. This one has a max reward of $4,000. So very different risk profiles, but depending on what your views are in the different markets, this will actually show you how you can profit. So right off the bat, if what happens if Morgan Stanley goes back to that 50 support level and kind of just stays where it is, right? Which is very possible in an inverted head and shoulders. So if the stock stays at $50, as you can see, only a credit spread is really making me any money. I'm making $825 credit, which is the credit that I'm receiving for this credit. And on the vertical that I bought, I'm actually losing $1,500. So if you expect that this is a reversal pattern, but you don't think it's going to rally very high, you will want to sell this credit spread. That is the only strategy that's going to make you any money. But if you expect that this is an inverted head and shoulder and it's going to bounce a little higher, let's say you think it's going to go to 52 and a half, let's say, how did these two fare? One makes $825 profit, one makes $923 profit. So very similar profit potential on each one of these two strategies if you expect the stock to rally modestly. What happens if you think it's going to move much higher to, let's say, 55? If you think the stock's going to move all the way up to 55, as you can see, this is where it gets a little interesting. Here, I'm still only going to make $825 because that's the most amount of money you can make from a credit spread. But on the vertical here, on the debit spread, I'm going to make $4,000. So almost 5 times the amount of money that I'm going to make on the credit spread if the stock does rally. So this is really where you have to then go back to your charts, look at your charts and say, do I think this is a reversal pattern that's really got some legs to it because the fact that financials are pretty strong, interest rates are rising. I think stocks like Morgan Stanley are going to do well in this environment. If I do think so, a stock move up to the 55 level back in September doesn't sound that crazy because it made that move relatively quickly within 1 month. So maybe in a month's time, and I'm going to give this 52 days, so about a month and a half time, that if it does rally to $55, I can potentially make double my money effectively, double the amount of money I'm willing to risk on this particular trade versus just trying to receive $825 credit. And if you don't have as much confidence in that rally and you think the stock's just going to move modestly, that's when you know for a fact that your credit spread is going to be a better trade. This tool is designed to really allow you to compare different strategies side by side and definitively look at how will they perform in different environments and what your expected losses or gains are for each one of these individual strategies. Now, I know I'm running out of time, but I want to provide as many examples as possible. Let's take a look at Michael Kors. Michael Kors is, to my eye, very simple, kind of like triple, quadruple top, whatever you want to call it. It really struggled to get above the 68, 69 level for quite a few months. In May, in April, in June, July, pretty much could not get above this 68, 69 level. So this is very what I would consider kind of an example of a double top or triple top reversal patterns, basically saying that I don't think it's going to go above 69.70. So this is typical for selling a credit spread. So let's take a look at being bearish and selling a credit spread. And let's say I'll sell the 67.5. Let's say I'll sell the 70s, which are pretty conservative, and I'll buy back the 72.5 versus buying a put spread, meaning a debit spread. As you can see, there was some pretty violent moves to the downside when it did hit this level. So it's not that crazy that this stock can go back down to $60 or at least $62 very, very quickly. So I do want to make this comparison and say, okay, let's say I'm, again, willing to risk $2,500 on this trade. It'll click on the calculate button. It'll tell me that I can sell 13 contracts with the credit spread and I can buy 6 contracts with the debit spread. So let's take a look at this. What happens if it just simply stays where it is around 66? Again, the credit spread is really going to be where you're going to get your bang for your buck if you don't think the stock's going to go any higher and it's just going to stay where it is. Even if it goes a little higher, even if it goes up to $70, you're still going to make your $910 credit. So you still have a bit of room to the upside so that even if the stock just stays range bound or even moves a little higher, you can still make money while this strategy is actually losing you a substantial amount of money. Conversely, if let's say the stock goes all the way down to 62, which is, again, we've seen that quite a few times over the last few months, so not a stretch in my opinion. If it goes down to 62, as you can see, these two are almost identical. It's $910 versus $990. So this is telling me that the stock really needs to make a pretty substantial move to the downside before this strategy starts to outpace this strategy. So maybe I'm not as confident in this particular trade on the right, the debit spread, because it really has to move quite a bit lower before I'm going to make a nice profit. I'd have to probably hit around 60 bucks. Before it becomes even interesting. So here at 60 bucks, this will make me a $2,000 profit versus a $910 profit. So at that pace, you know, this stock would really have to make a pretty big move to the downside. So if I was comparing these two strategies, I'd probably pick this one in the middle, because if the stock stays where it is or even moves a little higher, I'm going to make that 910. And if it moves even substantially lower, it's not going to give me much more less profit than the debit spread. Only in the scenario where the stock really moves lower is the debit spread better. So this allows me to definitively say between these two strategies, I'd probably pick that call vertical or that credit spread for this specific trade. I'm going to have time for maybe one last one. Let's look at BlackRock. This is a financial services company that recently broke below what I would consider as a major support level. So I was looking at this chart, and around 510 is really where I saw quite a bit of support back here in February, bounced higher off that level in April, bounced off that level in May, and then finally cracked here at the end of June. It broke below 510. Kind of consolidated a bit since then, but has moved lower off that 510 level. So this is a classic, you know, break below a support level, comes back to test it as resistance, and starts to move lower again. So this is a pretty clear sell signal, in my opinion, on this specific stock. Granted, it's in a relatively strong sector, so I may not be as convicted on a big move lower, but I'm certainly confident that I don't think it's going to go above 510. So if that's the case, again, let's take a look at selling a credit spread. Or you know what, let's do this. Let's take a look at selling the credit spread. Let's say I sell the 510, 520 credit spread, and maybe I'll do it on September, the September options. And what I'll do is I'll compare that with buying a debit spread, and I'll compare that with buying a put. So we talked about, you know, when you expect a large move in one direction or another, sometimes you can buy a put option instead. Let's take a look at how that actually performs. So again, let's go back and let's say I'm willing to risk $5,000 on this trade, which means I can sell 7 contracts for this vertical, I can buy 2 puts, or I can buy 3 debit spreads. So this really allows me to play with any different types of strategies, but these are the 3 strategies that we talked about that are generally useful with technical analysis. So let's go back to the drawing board and say, well, BlackRock's at you know, we think 510's that support, that resistance level that's not going to go above. So let's say what happens at 510. At 510, the only strategy that's going to make you any money is selling that credit spread. If you bought the put or bought that put spread, you're going to lose pretty much all your capital, right? So we knew that's the case. So if you don't think that BlackRock's not going to move very much, you think 510 is a resistance and it's not going to go above that, but it could pretty much just stay where it is and not move a lot, then you might want to sell this credit spread. But if, let's say, you have a fair amount of confidence that, you know, this stock has really kind of spent a lot of time above this 510 level and has finally cracked below it, and I think it really can move down to maybe 480, 460, these support resistance levels that I see below there, then that's really when you want to consider buying a put or a put vertical. So if you think it's going to go to 480, as you can see here, I make $2,200, I make $2,000 on the put, I'm going to make $4,200 on the put vertical, the debit spread. So I'm making almost double the amount of money on this credit spread with the debit spread if the stock moves modestly down to what I consider a modest move down to 480, because 480 to now is only about a $20 move, and this stock can move $20 in the matter of a few days. So it's not that crazy for me to think that it's going to move down to potentially 480. But if it moves down to, let's say, 465, which I would say is a bit of an extended move, but still not out of the realm of reality, I can make a $7,200 return on this debit spread versus buying a put would give me a $5,000 return, and the credit spread only, again, limited me to $2,200. So this is really where Depending on how you want to use your technical analysis, there's many different ways how to do it, but make sure you keep in mind, do I have a clear entry and do I have a clear exit? If you have a clear exit, then you might want to take a look at these debit spreads or maybe buying a put or a call if you expect a quick move in one direction or another. But if you don't have a quick move, or if you don't have a clear directional view, if you don't have a clear target price, you might want to take a look at selling credit spreads instead, because that really allows you to take advantage as long as the stock doesn't move in the opposite direction. So with that, what I'm going to do is I'm going to open up this for Q&A. We've talked a lot about a lot of different strategies and a few different forms of trading. So I want to answer as many questions as I possibly can on this specific strategy, because we did cover a lot of things. So I'll answer as many questions as I have time for. Please, if you have any questions, type them into the chat window. Michelle's asking, it shows buy shares was far out of your investment range. Michelle, I'm not sure what you mean by buying shares is far out of your investment range. Buying shares is probably the simplest strategy that you can use for a bullish or bearish view. However, they give you linear risk reward, so meaning $1 if it moves in your favor, $1 loss if it moves against you, which means that you can have potentially unlimited losses if you're shorting a stock. So that's really why we prefer using options, because you always have limited risk when you're using options. Michelle's asking, what do the circle numbers in each option mean? So the circle number, great question. Circle number is meant to give you an idea as far as the risk of each strategy. And what we're referring to is the specific risk or reward of each strategy. So as you can see, each strategy has a certain amount of red, which means potential for loss, and a certain amount of green, which is potential for reward. And there's different probabilities of risk and reward. So what we want to do is give you a quick way to gauge what is the actual trade-off between risk and reward, and how well balanced is that? And that's what the OptionsPlay score tells you, is how well balanced the risk reward is. Green means red, yellow means average, red means poor. This is all color-coded for you so that you don't have to memorize these or know exactly what's good, what's bad. They're all color-coded for you, so you know exactly what's a good risk-reward trade, what's an average one, and what's poor. Rick is asking, I notice all of these call put options are suggesting in the money with about a 60 delta. Rick, that's absolutely true, and that's by design, because buying a slightly in the money call option or a put option is always where you generally want to start as a starting point when you have a bullish or bearish view on any underlying stock. You don't, and the reason for that is because you want a piece of that being intrinsic value and some of it being extrinsic value. Because if you're just buying calls or puts, one of the biggest downsides to just outright buying calls and puts is that time value is eroding very quickly against you. And the only way to really minimize that is buying slightly in the money call options or put options, so that even if the stock doesn't move a lot, you're not losing 100% of your option to time value. And that's really what causes most people that buy calls and puts to simply lose their money and not come back over and over again. Buying slightly in the money call options allow you to offset some of that. And you can do that even further by buying this debit spread, which even further reduces your risk, reduces your time decay. And that's really why these debit spreads is our preferred strategy if you have a directional view. Where do you find sector trend data? So a great question. So we like to use the sector ETFs. So for example, like XLE, you can use all of the sector ETFs as your proxy. So, there's 10 sectors, XLE, XLF, all of those. You can use those quickly to gauge, we have a technical score on each one so that you can set up a watch list for all the sectors. And that allows you to quickly look at the individual sectors of individual sectors using these ETFs. Michelle, the first option you were showing, it showed the investment was 16,000 rather than 2,500. Oh, I think what you're referring to is this. Let's go back to this. So I think I was risking $2,500. But the investment shares was $16,000. You're right, because because we can't really compare buying stock to buying a call. So this is the closest. What we're doing is we're basically saying that if the stock was to go down 2 standard deviations, as you can see, the loss here is roughly $2,500. So what we wanted to do is not necessarily tell you how much stock you needed to do, because if you only bought $2,500 of stock, then it would have to go to 0 before you lost $2,500. We wanted to assume a more realistic scenario, so meaning if the stock really took a big hit, so here, if it went down 2 standard deviations, you would lose roughly $2,500. That we thought was a better comparison for strategies than simply just buying $2,500 worth of stock. William, it was not clear what you clicked on to see the dollar amount of your risk. Oh, you just clicked on the OptionsPlay score. If you click on the OptionsPlay score, it'll tell you what your max risk, max reward, everything is. So the breakdown of how we calculate the OptionsPlay score you can find by clicking on the OptionsPlay score. Does the strategy use IV theory? It does, and how we do it is actually through the OptionsPlay score. So as you can see, this XLF gives you an OptionsPlay score of 77 when you're buying, telling you that it's a relatively expensive option that you're buying. If let's say we're selling this option, if we're selling this option, as you can see, you get a very high OptionsPlay score because this currently has a relatively high implied volatility. So if you're selling, it gives you a much higher OptionsPlay score versus than when you're buying, which gives you a much lower OptionsPlay score. So we do that through the OptionsPlay score. David's asking, do call verticals and put verticals equate to credit spreads and debit spreads? No. So, okay, great question, actually. So a debit spread is when you're buying a call. So we actually have a specific webinar that we've done on this, David, and the title of that webinar was Trading Debit versus Credit Spreads. I actually think that that's probably a good video for you to view because it gets really in depth into what a credit spread means and what a debit spread means. So I hope that webinar will be able to help you to do that. Scott, if you don't mind, if you can send a link to the recordings so that people can view that debit versus credit spread webinar, that'd be great. Because a debit spread is, a call would be a bullish trade, a call vertical that's a debit is bullish, a call vertical that's credit is bearish. So it's actually the opposite of each other. So we actually have a webinar. So as you can see, a call vertical can either be bearish or it can be bullish. When it's bullish, that's a debit spread. When it's bearish, that's a credit spread. So we have a specific webinar just on that alone. Rick is asking, can you explain the income button just above the, so the income button is different because this is a completely different strategy. So many of you will sell cover calls and cash secured puts. So let's say you wanted to figure out which cover calls should I sell on Goldman Sachs because you own Goldman Sachs. This is a tool designed to do the same thing that trading does for finding new trading strategies, but income does it for helping you find cover call and short put strategies. So if let's say you own 200 shares of Goldman Sachs and you want to sell some cover calls, what we allow you to do is actually create what type of time frame you're looking at, what kind of risk tolerance you have, and we'll return to you the cover call and short put that matches your criterias. So this is designed to give you a starting point for cover calls instead of having to pull up a chain every single time that you want to sell a cover call and having to manually search through the chain, figure out which expiration date, which strike price. This does all of that work for you and just returns to you the ideal starting point and gives you all the analytics that you need to decide. So Goldman Sachs pays a 1.3% dividend yield, not a spectacular dividend yield, but this cover call pays a 5.7% annualized yield, which brings your total yield to 7.4%. So this is the type of analytics that you would typically look for to say, is this enough yield? In this particular case, it is, and you can hit the trade button. And one of the great things that I didn't get a chance to really explain is that when you hit the preview order button, we actually pre-fill the ticket for you. So you don't have to actually enter anything manually. Everything gets automatically populated for you from OptionsPlay, and this is the case for if you're trading debit spreads as well. So if, let's say you're looking at this Goldman Sachs debit spread and you want to buy it, you click on the trade button. You can hit the preview order button and everything is pre-filled for you so that you don't have to enter anything manually. This is designed to help provide, or reduce reduce the chances of you making a mistake on entering your your order ticket, because sometimes there's so many things to enter. You may flip a buy to sell, or different expiration date or different strike price. Next thing you know, you're trading a bear spread instead of bull spread. So these are the ways that we built this tool to help reduce the amount of, or the chances of you placing a bad order. Are there any other questions regarding any of the things that I went over here today? Again, I went over a lot of things today. I went over a lot of different forms of technical analysis. I went over quite a few different strategies. I went over quite a few different examples. I don't expect anyone to memorize everything and have gotten everything, so I highly recommend you to take the time and view the recording. I have a question here asking to see the sectors. So if any of you are familiar with the sector ETFs, there's 10 of them. I highly recommend you to consider creating a watch list for the sectors. There's XLK, XLU, XLP, XLY, V, F, RE, I, B, and E. Those are the 10 sector ETFs. And what I usually like to do is I like to sort it by the score, because that tells me which sectors are strong, which sectors are weak. So energy and utilities are some of the strongest sectors right now, and some of the weakest sectors are financials, consumer staples, and industrials. So this sector ETF allows me to quickly quantify which sectors are strong, which sectors are weak, and that helps me set up my ideas and my views for each individual day. So I recommend you to use these sector ETFs as your proxy for figuring out how each sector is doing. Carla, thank you very much. I appreciate it. Any other questions?
Okay, that sounds good, Tony. Thank you so much for going through all the audience's questions.
Hey, Scott.
We were just, yeah.
Can you send a link in the chat window to everyone for the link to all the recordings?
Sure, absolutely. Yeah, we're going to send them out over email as well, but I can, let's see here.
At this point, we've done about
yeah, let me.
We've done about 8 different webinars now, so we have quite a few recordings for you guys to review, including this one. So we'll send everyone the link so that you guys can have access to the previous recordings. That'll be a great way for you guys to review all the different things that we've done before.
Right, so if you go to I'll share the link here, and then on our website, eOption.com, and then we have an OptionsPlay section, and then I'll copy it here. Here's all the video recordings. We have an overview of OptionsPlay, trading earnings with limited risk using OptionsPlay, generating income here. Again, these are all the webinar recordings, gain a directional edge, trading your first option. Someone mentioned earlier wanting more information on credit versus debit spreads. That's there too. And then this one will be up there as well, which we will email. And so let me just find the chat box. There you go. It should be going to everybody who's still on. You can access the link. You might need to copy and paste it there. eOption.com/OptionsPlay. For those of you who have any questions, please contact your brokerage support team. Again, you can find the OptionsPlay webinar, the OptionsPlay feature on your platform there in the tab, just as Tony was showing. If you have any questions, please contact your brokerage support team. Our next webinar will be Tuesday, August 7th. So be on the lookout for that next topic. And we'll again have Tony as the speaker for that. So thank you very much, Tony. We really appreciate it. And thank you to everyone who attended. And be on the lookout for our next webinar and for the webinar link recording for today's. Okay, everyone have a great rest of the day. Bye-bye.